For an investor in their 20s looking at the stock market today, the view is chaotic. Every day brings a new cycle of price swings, shifting public sentiment, and loud financial headlines. The natural impulse is to seek the stability of cash, but cash carries its own mathematical certainty. Over any extended period, inflation reliably erodes its purchasing power. To find a different path, we have to look at the dataset compiled by Jeremy Siegel at the Wharton School. It tracks the continuous returns of stocks, bonds, and cash bills across 2 centuries of history, from 1802 to the present day. Looking at this map, we have to ask, what happens to our perception of risk if we stop reacting to the year-to-year swings and zoom our perspective out? The data suggests that market volatility is a matter of resolution. What looks like random danger on a short timeline often reveals a different pattern when we change the scale of our observation. Using a 20-year rolling period, we break the 200-year history into overlapping 2-decade chunks, sliding forward yearly. The result? Across every 20-year period since 1802, despite wars and depressions, diversified equities never produced a real loss, consistently staying above the zero-loss baseline. Short-term price movements, over a year or two, are largely driven by human emotion and market noise. It's a period where sentiment matters more than substance. But over 20 years, those emotions fade. Long-term returns anchor instead to the underlying growth of corporate earnings. These earnings compound, generating value that builds on itself rather than just fluctuating. In this way, time acts as a structural filter. It removes the influence of temporary panic and leaves behind the signal of steady economic progress. We can test this by looking at the most extreme example: an investor who put their money into the market right before the 1929 crash. By the lowest point of the Great Depression, that portfolio lost 80% of its nominal value. On a short-term horizon, the loss was catastrophic. However, by 1949, the end of that 20-year window, the compounding growth of the surviving businesses had completely absorbed the impact of the crash. Despite the worst financial crisis in modern history, the investor finished with a positive real return. The math of a 20-year holding period is powerful enough to outlast a total market collapse. If you are in your 20s, this isn't just history, it's a massive logistical advantage. Capital invested now has the time to go through 2 or more of these 20-year cycles before you need it. This chart compares a 40-year trajectory to a 20-year one. The widening gap shows why time is more valuable than income. A salary increase at age 40 cannot easily replace the 2 decades of compounding you missed by waiting. Of course, historical data describes what happened, not necessarily what will happen. We cannot assume the conditions of the last 2 centuries will be identical to the next. We see this risk in the Japanese market. An investor who entered at the 1989 peak faced a market that failed to recover its value for over 30 years. It's a reminder that a single country's economy can stagnate, regardless of what the US datasets show. Time is a shield, but only if it's paired with diversification. To protect against the failure of any one nation, you have to spread your investments across the global economy. Your challenge this week is to move from theory to action. Calculate exactly what percentage of your income is going into a diversified, long-horizon asset, and increase that amount before the month is over. By starting now, you aren't trying to outguess the market's noise. You are positioning yourself to participate in the long-term productivity of the global economy.